Greetings, fellow financial adventurers. Welcome to our channel Snap Savings, your fortress of financial wisdom.
Saving money is crucial for financial security and achieving your financial goals. Whether it's buying a home, funding your children's education, or retiring comfortably, having a solid savings plan is essential. Start small and gradually increase your savings rate as your income grows. Every dollar you save is a step towards a more secure future. The importance of saving cannot be overstated. It provides a safety net for unexpected expenses, such as medical bills or car repairs. Saving also allows you to take advantage of opportunities and pursue your passions. Without savings, you may find yourself in a cycle of debt and financial stress. Saving is not just about accumulating wealth, it's about having peace of mind. Knowing that you have a financial cushion can reduce stress and improve your overall well-being. It empowers you to make choices that align with your values and aspirations. Traditional savings accounts are a popular choice for individuals looking for a secure place to store their money. These accounts are offered by banks and credit unions and typically come with FDIC or NCUA insurance, which protects your deposits up to certain limits. While traditional savings accounts offer safety and security, they generally provide low interest rates, which can limit your potential for growth. One of the main advantages of traditional savings accounts is their liquidity. You can easily access your funds whenever you need them, making them suitable for emergency funds and short-term savings goals. However, the low interest rates offered by traditional savings accounts mean that your money may not keep pace with inflation. Despite their low returns, traditional savings accounts still play a vital role in a well-rounded financial plan. They provide a safe and accessible place to keep your emergency fund and other short-term savings. Consider them the foundation of your savings strategy. For those seeking higher returns on their savings, high-yield savings accounts and money market accounts offer a compelling alternative to traditional savings accounts. These accounts typically come with higher interest rates, allowing your money to grow at a faster pace. However, they may have higher minimum balance requirements or limitations on withdrawals. High-yield savings accounts and money market accounts share some similarities. Both offer higher interest rates than traditional savings accounts and provide FDIC or NCUA insurance. The main difference lies in their liquidity and potential returns. Money market accounts often come with check-writing privileges and debit cards, providing greater flexibility in accessing your funds. However, their interest rates may fluctuate based on market conditions. High-yield savings accounts, on the other hand, typically offer more stable interest rates, but may have limited or no check-writing privileges. Certificates of deposit, CDs, are time deposits that offer a fixed interest rate for a specific duration, ranging from a few months to several years. By locking in your money for a predetermined period, you can potentially earn higher interest rates compared to traditional savings accounts or money market accounts. However, it's important to note that early withdrawals from CDs typically come with penalties. CDs are suitable for individuals who have a lump sum of money that they don't need to access for a specific period. They provide predictable returns and can be a valuable tool for achieving long-term savings goals. However, if you anticipate needing access to your funds before the maturity date, a CD may not be the best option. When choosing a CD, it's essential to consider the term length, interest rate, and early withdrawal penalties. Longer-term CDs generally offer higher interest rates, but also lock in your money for a more extended period. Carefully assess your financial needs and risk tolerance before investing in a CD. Money market funds are investment funds that invest in short-term, low-risk debt securities, such as government treasury bills and commercial paper. They offer a balance of liquidity and potential for growth, making them an attractive option for individuals seeking a relatively safe investment with the potential to outpace inflation. However, it's important to note that money market funds are not FDIC insured. One of the key advantages of money market funds is their liquidity. Investors can typically withdraw their funds easily, making them suitable for emergency funds or short-term savings goals. However, their returns are not guaranteed and can fluctuate based on market conditions. Money market funds are generally considered low-risk investments but are not without risk. The value of your investment can fluctuate, and there is a possibility of losing money, although it is rare. It's essential to carefully consider your risk tolerance before investing in a money market fund. Bonds are debt securities that represent a loan made by an investor to a borrower, such as a corporation or government entity. When you invest in a bond, you are essentially lending money to the issuer in exchange for regular interest payments and the return of your principal at maturity. Bonds offer a fixed income stream and can be a valuable addition to a diversified investment portfolio. Bonds are often categorized based on their credit worthiness, with those issued by the U.S. government considered among the safest. Corporate bonds, on the other hand, carry varying levels of risk depending on the financial health of the issuer. It's important to research and understand the creditworthiness of the bond issuer before investing. The interest rates offered by bonds are influenced by various factors, including prevailing interest rates, inflation expectations, and the creditworthiness of the issuer. When interest rates rise, bond prices tend to fall, and vice versa. Understanding the relationship between interest rates and bond prices is crucial for bond investors. Stocks represent ownership shares in publicly traded companies. When you invest in stocks, you become a part owner of the company and share in its profits and losses. Stocks offer the potential for high returns, but also come with higher risks compared to bonds or cash equivalents. Investing in stocks requires careful research, diversification, and a long-term investment horizon. The stock market can be volatile in the short term, with prices fluctuating based on a wide range of factors, including economic data, company earnings reports, and geopolitical events. However, over the long term, the stock market has historically trended upwards, providing investors with the potential for significant capital appreciation. Investing in stocks is not for the faint of heart. It requires a certain level of risk tolerance and the ability to withstand market fluctuations. Before investing in stocks, it's crucial to have a solid understanding of your financial goals, risk tolerance, and investment time horizon. Mutual funds and exchange-traded funds, or ETFs, are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of assets, such as stocks, bonds, or other securities. They offer investors a convenient way to diversify their portfolios and potentially reduce risk. Mutual funds are professionally managed, with a fund manager making investment decisions on behalf of the investors. ETFs, on the other hand, typically track a specific market index or sector, and are passively managed. Both mutual funds and ETFs come with fees, known as expense ratios, which can impact your overall returns. When choosing mutual funds or ETFs, it's essential to consider the fund's investment objective, expense ratio, historical performance, and the experience of the fund manager. Carefully research and compare different funds before making an investment decision. Real estate has long been considered a tangible and potentially lucrative investment. Investing in real estate can provide various benefits, including rental income, potential for property appreciation, and tax advantages. However, real estate investments require significant capital outlay, ongoing maintenance costs, and can be illiquid. Rental properties can generate a steady stream of passive income, but they also come with the responsibilities of being a landlord, such as finding tenants, collecting rent, and handling repairs. Property values can fluctuate based on market conditions, and there is no guarantee of appreciation. Before investing in real estate, it's crucial to conduct thorough research, consider your financial situation, and seek professional advice. Factors to consider include property location, market conditions, potential rental income, and your risk tolerance. Retirement accounts, such as 401(k)s and IRAs, are tax-advantaged savings plans designed to help individuals save for retirement. These accounts offer various tax benefits, such as tax-deferred growth or tax-free withdrawals in retirement, depending on the specific type of account. Contributing to a retirement account is one of the most effective ways to save for your future. The power of compounding, where your earnings generate even more earnings over time, can significantly grow your savings over the long term. Start early, contribute consistently, and take advantage of employer matching contributions if available. When choosing a retirement account, consider your employment status, income level, and long-term financial goals. Traditional 401(k)s and IRAs offer tax deductions on contributions, while Roth 401(k)s and IRAs provide tax-free withdrawals in retirement. There are numerous options for stashing your cash and growing your wealth. The best approach is to develop a personalized savings strategy that aligns with your financial goals, risk tolerance, and time horizon. Diversifying your savings across multiple asset classes can help mitigate risk and optimize your potential for returns. Start by building a solid foundation with a traditional savings account for your emergency fund and short-term savings goals. Consider high-yield savings accounts or money market accounts for higher returns on your liquid assets. Explore longer-term savings options such as CDs, bonds, stocks, or real estate, depending on your risk appetite and investment timeline. Remember to regularly review and adjust your savings strategy as your financial situation and goals evolve. Consult with a financial advisor for personalized guidance and to ensure your savings plan is on track to help you achieve financial security and reach your financial aspirations.
Don't forget to like, share, and subscribe for more profound insights into mastering your financial journey.